Hi. The numbers you're looking at on the screen are available pretty much to anybody. This is actually a graph that is supplied by the Hartford Funds, it's a mutual fund company, that is accessible publicly. Your advisors have it. If you're an advisor, you've seen this. And the numbers are what the numbers are. We can take a look at over the past 30 years, the average individual investor has underperformed a typical equity mutual fund that invests in the S&P 500 by almost 350 basis points. That is a lot. It's the difference between doubling your money every 7 years maybe and doubling your money every 10 years. And those numbers begin to add up. Why? Because investors get nervous. Investors are driven by emotion. Investors tend to move in directions where they feel safe and comfortable because everybody else is in that direction. Interesting observation. If everyone in the public agrees that the stock market is no good and you shouldn't be there, have they all sold already, or are they still holding equities? They've sold. Everybody agrees you've got to be in the market. You've got to be there. They've all bought. Who's left to buy? Emotion drives underperformance every single time. In equities, it's as plain as day. Even worse, if we look over on the right side of this chart and we see the average fixed income investor at a 0.34%, that's 0.34% total rate of return going over a 30-year period, and a bond index, which isn't even a real bond, but the Bloomberg U.S. Aggregate Bond Index over the same period, 5.29%. Why? Same reason. It's driven by two factors. I'll get into why there's such dramatic underperformance in the bond market in a later video. It has a lot more to do with cash flow and dilution and nothing whatsoever to do with the fact that these bond managers don't know what they're doing. They do what they do, but they can't beat these two issues: recency bias and confirmation bias. These are the two biggest problems if you're an individual investor you're dealing with every single day. Whatever's been happening is likely to continue happening. Confirmation bias, once you make a determination as what you believe is going to continue to happen, what do? What do you read? You read the things that support what your belief structure is. It's human nature. You're in your own private echo chamber. You think the market's going up. The algorithms that power your news feed, no matter what news feeds you're using, basically are going to give you everything that affirms that opinion, so you'll read it and look at the ads on the other side. If you're an investor and you've got an advisor, your advisor understands these things. And if he's guiding you in ways that feel emotionally incorrect for you and you push back, you do so at your own peril. And you should probably just go online and do it yourself, because it's frustrating to your advisor. Yes, we know it's your money. We know you're going to make those ultimate decisions, but we also know they're not in your best interest. If you are an advisor and you actually listen to your clients who want to make these emotional responses and emotional reactions, you've got to sign off. You've got to guide them to go elsewhere, because that's not what you do as an advisor. Your job is not to manage good investments in the equity market. Your job is to manage the emotional response to these two twin pillars, which have been impeding investor return for as far back as we can remember. If you're a client, let your advisor do their job. They'll tell you what you need to know. They'll tell you not what you always want to hear. If you're an advisor and you're not willing to push back against a client who wants to go their own way and they're going to hold you responsible for the outcome, fire the client. Go find clients that are going to actually listen, because they're going to do better long term. Thanks for your time.